What is up, guys? Alp27HD here, also known as Ian, and I wanted to bring you a video on process over outcome. Now, this has been massive for me. It's something you'll hear me speak about often in the mindset room and the general, pretty much all over the Discord, is process over outcome, or the subtle art of saying F you to your profit and loss. The idea being that if your process is correct, if you follow your process to the letter, the outcome should, in theory, take care of itself. It revolves, in my journey with regards to this, revolves around our lovely Roxy. You know, Roxy from the Mindset Room and Discord in general. She's been on loads of live streams, etc. Everyone knows Roxy. She's lovely. And she basically set me a challenge of pass the test. And this links in very nicely to a podcast that Roxy and I had listened to, where this very topic came. So the podcast in question is called Traders Mastermind, and it's by a guy called Mark. You will probably know his YouTube channel. He has a YouTube channel called UK Spread Betting. But basically, he has a podcast. It is all about trading psychology, getting your mind right, all that sort of stuff. But on the 10th of December 2021, he did a podcast called Pass the Test. So trading tests you when you least expect it, but it's often disguised as a meaningless decision that goes unnoticed. So spot the test and pass the test. So Roxy and I had both seen this podcast video or podcast, listened to it. Basically, the idea is that you will find yourself trying to stack good trades. So with the pass the test, the idea is it's a bit like habit stacking. I don't know if any of you guys have ever listened to Atomic Habits or read Atomic Habits. I listened to it on audiobook. It's a brilliant book about basically getting your habits in day-to-day life. And as part of that, they talked about habit stacking, where you do the same thing over and over again, and you start to get a streak going, 10 times, 15 times, 50 times, 100 times. You don't want to break the streak. And the idea is that when you're trading, if you do your first trade and it is to the letter, absolutely perfect, even if it loses, you passed the test. You did your trade to your plan and to the letter. Your next trade, you pass the test. That might be a winner. Your next two trades, pass the test, might be losers. And the idea is that you're stacking, so +1, +2, +3, +4. You don't want to break that habit. So Roxy set me a challenge of pass the test. All she said is, for a month, you trade to the letter with your system. Now, as an extension of this, I took it one step further. I took Jay's trading journal that he created, and I added a series of additional columns. There's also a guy, Pat Bellini, I think his name is. We've shared a lot of his videos in the Mindset Room. So he has a system of putting a before and after trade section. So before the trade, you ask yourself, what are my expectations? So in my case, a 0, perfect entry, totally zen, if that is the case. And does the trade meet my trade plan criteria? Does my trade meet my trade plan criteria? Yes, it does. So you're able to enter the trade. You're saying it meets my criteria, so we are passing the test, and my expectations are 0. If you go in thinking it's going to go to the moon, or it's going to hit this level, or it's going to go down, you are setting yourself up for a disappointment. You need to manage expectations. Ideally, you want to enter a trade with 0 expectations. All you need to think is something will happen when I enter this trade. The next section is something that's looked at after the trade. So you look at your emotional state, 1 being cool as a cucumber and 10 being running around with the house on fire and blowing your account and all hell breaks loose. And then you look at any refinements. So for example, on my trade, it was Friday grind. So moved to break even and hit. So that was my refinement after the trade, but I was perfectly calm at the time. I just observed that it wasn't doing what we expected. With it being a Friday, we made a small tweak to the refinements. And then you look at outcome. So the outcome, what went wrong and what went right. And then finally, I set what we call a compliance level. Now, this is my pass the test. So I start on 0, and every time I do a perfect trade, I get a +1. And then the next day, it starts at 1. And if I get a perfect trade, I get a +2. Then if I get another perfect trade, I get a +3. If I mess up, it goes down 1. So it goes from +3 to +2. Or if you really mess up, you could zero the compliance level completely. Now, the compliance level is entirely up to you. You could look at it and say, well, my idea is to habit stack to pass the test. If I fail a test, I go all the way from +30 for 30 positive trades in a run, right the way back down to 0. That's really down to you to decide. But the compliance level gives you a way of tracking, am I doing each trade perfectly? Am I passing the test? So it may be worth considering adding something like that to your trading journal. What are my expectations before entering? Does it meet my criteria? What were my emotions during the trade? Any refinements? What went right? What went wrong? And can you stack the compliance levels? Moving on, you do not need to be getting a 100% win rate or an 88% win rate to make money. As long as you've got a reasonable RR, i.e. 2 to 1, 3 to 1, 4 to 1, 5 to 1, you will make money. Even at 1 to 1, you will make money. You will break even at 50%, and at 60% you will be profitable. And you can see there, if you have a 50% win rate on your trading and you get 2 to 1, so for every £100 you put on, you aim to make 200, you will be profitable at 40%. And then obviously as it goes up, even at 5 to 1, if you're going for these big Brutus trades at 5 RR plus, even at 20% success, you will be profitable. So this is, again, reiterating with the pass the test. You do not need to be hitting everything 100% win rate or 88% win rate. As long as you are following your plan to the letter and your plan will deliver enough RR with a decent enough win rate to make you profitable, that is all you need to worry about. So that is what that table shows you. You do not have to be getting maximum win rates to be profitable as long as your R factor is of a reasonable level. And finally, process versus outcome. The 4 ways you can trade. Either of the top is perfect. The very worst is the bottom left. So you've got 4 ways in which you can trade. You can have good process, good outcome. So you enter a trade exactly to plan and you win. Good trade, good process, good outcome. You then have good process, bad outcome. So you follow the plan to the letter and your trade loses. Either of the top 2 is perfect. Good process, as we said before, F the P&L, process over outcome. Bad process, bad outcome, bottom right. So you take a Hail Mary trade, stuff it, I'll just throw in 20 lots on NAS, it'll be fine. It loses, you feel absolutely shitty. Worst case scenario, bad process, good outcome. You throw 20 lots on NAS. We all know the market is unique. Each moment is unique. And the thing goes right up and you make 10 grand. And you think, I am big bollocks. I can win every trade. I am the man. I can open all doors with my trading powers. And then the next time you do it, you lose. The next time you do it, you lose. That is the absolute worst because it feeds into bad behavior. And as I've said at the bottom, if you finish a day and all trades meet the green top line, you have won. Money, P&L and bottom line means nothing as long as you are passing the test and stacking your compliances. Hopefully that gives you a bit of an indication into process over outcome. And I would highly recommend you check out Traders Mastermind podcast. He has probably 2 or 3 podcasts a week. Each one's probably 10 to 15 minutes long. Loads of gems, absolutely loads and loads of gems in there. So I would highly recommend you check that out. Apart from that, look after yourselves, take care, and I will see you in the next one. My name is Al27HD, also known As Ian, you'll know me from the trading floor. I run the Mindset Room with Roxy, and also I'm quite hands-on with chatting to people within the Discord, etc. Wanted to bring you a video on the book Trading in the Zone. If you don't know it, Mark Douglas, fantastic, no longer with us unfortunately, but he wrote this book called Trading in the Zone, which is pretty much renowned as one of the Bibles of trading psychology. And within it, he talks about various things, and I wanted to do a bit of a deep dive into some of those topics. So let's move on to the next slide and we will dig down. So Trading in the Zone, within the book, Mark talks about the 5 fundamental truths of trading and also the 7 principles of consistency. So what are these? So let's have a look into what are these. The 5 fundamental truths of trading. Anything can happen, number 1. You don't need to know what is going to happen next to make money, number 2. There is a random distribution between wins and losses for any given set of variables that define an edge. Number 4, an edge is nothing more than an indication of a higher probability of one thing happening over another. And number 5, every moment in the market is unique. So they are the 5 fundamental truths of trading. We will now look at the pillars or principles of consistency. I like to think of them as the 7 pillars of consistency, because they basically prop up my trading. At number 1, I objectively define my edges. Number 2, I predefine the risk of every trade. Number 3, I completely accept the risk, or I am willing to let go of the trade. I act on my edges without reservation or hesitation. I pay myself as the market makes money available to me. I continually monitor my susceptibility for making errors. Irony. And I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. So let's have a look into these and move on to the next slide. So first and foremost, fundamental truth of trading, number 1, anything can happen. How many times have you been in a trade and you've thought it's going in my way, it's going in my favor, it's basically pointing in the right direction, the market is bullish, everything is right, it's bounced off the 61% fib, it is just broken a trend line, basically everything is going as it should, and then it suddenly reverses on you and the floor drops out of it and you lose. Anything can happen in the market. Don't be fooled into thinking there is a sure thing. Don't be fooled into thinking that you are onto a winner. Until that money is secured, anything can happen in the market. Fundamental truth number 1. Fundamental truth of trading number 2. You do not need to know what is going to happen next to make money. Nobody can predict the future. You do not need to know what is going to happen next to make money. You place your trade based on your trading plan. Imagine you want to become a surgeon. So you read some surgery books and some medicine books over the weekend, and then you pop along to the hospital on a Monday morning, and are you going to be able to successfully perform an operation? No, you are not. The problem with trading is that at any given time, I could throw a trade on after reading some books for the weekend, and I could be a winner. And I'm thinking, I'm the best trader ever. Just because you have a plan in place doesn't mean you're going to win. And just because you have a plan in place doesn't mean you're going to lose. You do not need to know what is going to happen next to make money. Moving on to number 3. There is a random distribution between wins and losses for any given set of variables. So let's say we've got a coin toss. There's something called the gambler's fallacy. So imagine I've got a coin. Each toss of that coin is a 50-50 chance. But let's say I toss a coin and it's heads, then I toss it again and it's heads, again, heads. What's coming next? Tell me, what's most likely to happen next? I've had 4 heads in a row. What's coming next? The answer is it's 50-50. That has not changed. There is a random distribution between wins and losses for any given set of variables. So if you had 20 trades, and your system back-tested shows that of those 20 trades, you are going to win half. So you've got a 50% win rate and you target 2 RR. So for every 1% you risk or 1,000 that you risk, you look to make 2% or 2,000. So ultimately you have, say, 100 trades. And of those 100 trades, half of them will be losers. Do you know which of those 100 trades are going to be losers? No, you don't. Do you know which of the 100 trades are going to be winners? No, you don't. It is a random distribution. How many times have you had 6 losers in a row and you're thinking, there's no way the next one can be a loser? And sure enough, bang, it loses. So there is a random distribution between wins and losses for any given set of variables. All you need to know is that you have an edge. You have back tested it, and you need to know that ultimately, if you were to take 100 trades and you win half with a 2 RR, you will make money in the market. You do not need to know which of those trades will be winners and which of those trades will be losers. Fundamental truth number 4, an edge is nothing more than an indication of a higher probability of one thing happening over another. So over the entirety of your trades, based on your trading plan, your edge is simply nothing more than an indication that you have a higher probability. So your higher probability is, in the case previous, 50%. So you know that according to your backtesting, 50% of your trades will be winners and 50% will be losers. Let that sink in. You're going to lose half your trades. So why get hung up on that one trade that you happen to be on? So an edge is nothing more than a higher indication of a higher probability of one thing happening over another. So there is a chance that basically of your 50 winners, you're aiming for 2 RR, you will make money. Simply that. There is an edge is nothing more than an indication of a higher probability of one thing happening over another. Fundamental truth number 5, every moment in the market is unique, completely unique. You often hear people say that future performance is not indicative of past trades or past events. What they're saying is every moment in the market is unique, and that there are the exact number of people placing the exact number of trades at the exact same time on the exact same moment. And so say, for example, something happens tomorrow and it goes up in a certain way, and the next day it starts to look like it's doing the same. It is still a unique event. It may look similar to the previous day, but it is a unique event in the market, and every moment is unique. Unless you're every single person placing every trade every single moment, then each moment in the market is unique. So don't get hung up on it going, it worked like yesterday, why is it not working today? Every moment in the market is unique. They are your 5 fundamental truths. Hopefully you got some benefit from that. Hopefully it gave you an idea of why the market is unique and that you don't necessarily need to know what's going to happen in order to make money. Let's have a little look at the principles of consistency. So I objectively identify my edges. This is your back testing. This is your forward testing. This is you spending the time to go over 100, 200, 500, 1,000 trades based on your edge and saying, I objectively define my edge. My edge is a break of structure. My edge is a bounce off the fib. Whatever it is, you've seen the Outback strategies, you've seen the DeLorean strategies. They basically give you your edge. It has been back tested for you, so you don't have to objectively identify your edge, because a lot of the people at the trading floor have done it for you. What I always stress is that the trading floor strategies are purely and simply a starting point, a framework, somewhere to begin. What you need to do is take that framework and make it your own. Pick the pair that suits you. Back test that pair yourself. I have complete faith in Christy and Jay and Bear and all the others, but I would still back test my own system if I am putting my own money on the line to create my edge. So I objectively identify my edge. That is the first thing you need to do. Create a system, back test it, make sure that it works, and then you will have your edge. Number 2, I predefine the risk of every trade. Stop loss, take profit. That is exactly what this is talking about. You predefine the risks. You should know before you hit go exactly how much you will lose if your trade goes against you, and exactly how much you will win if your trade goes in your favor. You predefine the risk, what is going to happen, and you are accepting of the worst case scenario. So for me, I would put my stop loss in place, stop loss, predefine the risk. I know that I am risking 500 because I'm basically doing 100k my Forex Funds evaluation account. So I know that I want to risk 0.5%, which is 500. So I know that if this trade goes belly up, the most I will lose is $500. If I win, I always aim for 2RR. I don't try and trail. I don't mess around. I get my profit and I look for another entry. I know that I will make 1,000. So my risks are predefined before you ever consider hitting go. So predefine your risk for every trade. Big underline there, every single trade. Not one, not two, not 10, not 15, every trade. It's the only way to make sure that things go according to your edge. If you don't have the risks to find, if you allow it to go past your take profit, you're then into no man's land. What if it goes past your take profit and then you miss your next entry because you were still in the trade that you are trying, in inverted commas, to make a little bit more money on? Predetermine or predefine the risk for every trade. Principle consistency number 3. I completely accept the risk or I am willing to let go of the trade. Now, a lot of you, if I say, do you accept the risk on this trade? Yeah, of course I accept the risk on this trade. I've put a stop loss in place, haven't I? You have, but how comfortable are you when the trade is pinging up and down and up and down, and you're thinking, oh shit, do I move my stop loss? Do I take my stop loss out? Oh, it's going to stop me out. And then it makes its way back up, or you move a stop to break even. Now, if your system, my system says that once I hit 1.5 RR, I move my stop to break even. That is my edge. That is my system. I have tested that, and 9 times out of 10, my trade will win once it gets past 1.5. If it doesn't, then I would like to cover myself and make sure that I don't lose money. So that is part of my edge. But you have to be completely willing to accept the risk and willing to let go of the trade, as in not take it, close it straight away. So the whole point is that you have placed your risk, you have placed your stop loss, you have placed your take profit, and then you need to take a deep breath and say, let it be. Let the trade do its own work. Number 4, I act on my edges without reservation or hesitation. How many times have you looked at it and gone, that's my entry candle. I'm waiting for it to close. I'm waiting for it to close. I'm waiting for it to close. It's closed. Oh, but it's dipped a little bit. It's gone down. Oh, and then the trade goes, whoa, straight up. And you look at it and go, now if I enter it, I'm already 20 pips above where I would have entered had I just hit go when the candle closed. I act on my edges without reservation or hesitation. Do not think, act. So act immediately without hesitation when your edge presents itself. Don't be the person that waits and then feels regret because it goes shooting up. The other danger is it goes shooting up, you enter the trade, your stop loss that was going to be 20 pips is now 40 pips. And your take profit that was going to be, 40 pips, so your take profit that was going to be 40 is now 80. The whole point is that it's not going to get there. You've made it harder for yourself. You've reduced your chance of winning. And not only that, you've messed around with the principles of your edge. And without it working to the letter, you can never review your results, review your errors, review your corrections, review your trades to see, can my edge be improved? Because your trades are haphazard. You've moved your stop losses. You've been hesitant in entering the trade. So I act upon my edges without reservation or hesitation. Number 5, I pay myself as the market makes money available to me. This is one I'm working on myself because initially I moved my stop loss to break even at 1.5. I've been toying around with the idea of saying the market has gone to 1.5. Should I pay myself something at that stage? Do I close 50% of the trade? Now, for me, with my edge as it's defined, I make the money when I let a trade play out. But you need to pay yourself as the market makes money available. This also goes back to the, oh crap, it's pushing up, it's pushing up. Let's just move my take profit up 20 pips. And then it goes to exactly where your take profit would have been. And then it goes all the way back down. And you look at it and think, well, that would have been a winner. And now it's going to go to break even, or at worst, it's going to go to a loss because you weren't prepared to pay yourself as the market made money available to you. So trust your take profits, trust your system, don't mess around with it, and pay yourself as the market makes money available to you. Principle of consistency. Number 6, I continually monitor my susceptibility for making errors. Your job is to correct errors. Your job is not to make money. Your job is not to win trades. Your job is not to do any of that. Your job is to monitor susceptibility for making errors and to basically plug those holes. The more you can follow your edge and follow your trades to the letter, the less chance you've got of losing and the more chance you've got of winning. People will often hear me say in the Discord, look after the process and the outcome will take care of itself. Focus on the process and the outcome will take care of itself. Continually monitor yourself for susceptibility to making errors. So look at it. Did I move my stop? Did I do this? Did I do that? Did I run my take profit too high? You might win the odd one. As I said before, you can't go and do surgery after a weekend, but you can certainly win a trade after a weekend. But does that make you a trader? No, it does not. So monitor your susceptibility for errors. Your sole job in this endeavor is to plug the holes and correct the errors until your edge is perfect. And number 7, I understand the absolute necessity for these principles of consistent success, and therefore I never violate them. Never, ever violate them. This is massive. Never violate them. I've been working with Roxy quite closely. You'll know Roxy from the Discord, from the Mindset Group, etc. Because I have regularly been doubling up on trades. I have blown funded challenges, etc., etc. It is only in the last 6 weeks that I have basically been following my edge to the letter and never violating my rules and my principles. And I am down on the challenge, but in terms of mental fortitude, I am right up there. To give you an indication, today I lost 4 trades in the first hour. My rule for my challenge says that I will stop trading for the day if I lose 4 on the bounce, or if I lose 2%, which is 0.5% by 4, so 4 trades. If I drop 2% on my account, or if I lose 4 on the bounce, I stop trading for the day. That happened in the first hour, and every single sinew of my body was screaming to look for more entries, to make back that 2,000 that I'd lost today. And it was hard. It was very hard. I was broken by it, but I did not violate my principles of consistent success. I said, your rules say that you stop. After 4 trades, you stop. And I watched other people making money and I watched other people losing money. But ultimately, I never violated my principles of consistent success. And if you can do that, you will win overall. Focus on the process and the outcome will take care of itself. So, what is success? What do you define as success? Last slide for you. And for me, success is following your strategy to the letter, day in, day out, week in, week out, and allowing the outcome to take care of itself. Success is following your system and consistently following your system. If you're going to journal every day, if you're going to journal every trade, journal every damn trade. Don't do it the ones that win. How many times have you gone, I journaled my 3 winners, but then I had 2 losers and I didn't journal them because, well, they hurt. Ultimately, they hurt. And I would argue, yeah, they hurt, but journal them. In fact, journal the losers more than the winners. They are the ones that will tell you the most about your trading. So success for me is following your plan to the letter without deviating and being confident in your edge, trusting your edge. If you have put the work in, you can trust your edge. And I spend every Saturday morning reviewing the week's trades. I look at it and I say, did I make any mistakes? No, I didn't. Have I lost or won this week? I may have lost a little bit from the P&L. I may have won from the P&L, but have I been successful? And as long as you are following your edge to the letter, you're a success and you will make money over time. I guarantee it. Any questions? You know where I am. Hit me up on the Discord. I operate an open door policy. You don't have to ask me to DM me. If you want to DM me, oh God, I want to get hundreds. If you want to DM me, just drop me a DM or pop into the mindset room. That mindset room, for me, I run it with Roxy. It's Roxy's baby, really, but she occasionally lets me come in and have a play. But that place, for me, is my center of the Discord. It's the place that I go when I need to say, Christ, it's been a hard day. And the support that comes from that place is massive. If you haven't been there, I would pop along to the mindset room. Come and say hello. There are some wonderful people in there, and you will get nothing but support in your journey. All right, signing off. Take care of yourselves, and I will see you in the Discord.
Hey, everybody, this is Roxy and Ian.
Hey, how you doing?
We have something special for you guys. We've both had many requests from the community to have something that is a journal that you guys can track your trades that really has a focus on mindset, where you can do it there every single day, track what you're doing and how you're doing with your mindset. We've created something for you, and we hope that it kind of fits what you need and that you enjoy it. So let us show you what this is. We have a few covers. This is going to be something that you can kind of build out how it best works for you. We've kind of created some options. So this is one of the covers with the TTF logo. We also have this one, which is kind of a fun color splash chart.
That's the one I've got on mine.
Yeah, it's a good one. And then the last one is this electrified effectively brain. And I think that one's kind of fun too. And
with all our wonderful ideas.
Yeah. So you guys kind of choose, this is how you start, kind of choose out what type of cover you want to build out your journal. And then there are 3 pages that you can print out as many as you want to use each and every day. So this first page here, this one allows you to do kind of a at the end review of how you did in the trading day. You have a section here where you kind of put in how you felt that day, like, hey, I felt really tired. You kind of want to pay attention to that. Or, hey, I felt really good this day. And that's a good quick symbol tracker there. And here you're going to put in your date, and then you're going to rate yourself. How did you do in following your rules that day? And then you're going to kind of list out, and you can do up to 3. And these can be like mindset goal. I'm having issues with FOMO, and then I'm having issues with revenge trading, or I'm having issues with FOMO, and then a couple subsets of FOMO, things that you're wanting to track that you're trying to do to address the FOMO, for example. And here you would rate yourself on how you did that day for each one of those mindset goals. And then down here, you have a section where you can do a little bit of tracking of your trades. For example, the number of trades that you took today, and then the number of trades that might have been out of plan. Did you make a mistake? Noted here. I basically took 4 trades, one of which was a mistake. And then down here, you list the number of winning trades, number of losing trades. For example, 2 were winning and 2 were losing. That's where you would put that there. And it just gives you a really quick way to track it so that it's not too complicated, not too detailed, but you have that to look back on and see how you did that day. And then again, following the mindset side of things in your journal, here you're going to note down at least one thing that you did really well that day, that you can be proud of, that that you succeeded on. And then over here, you're not going to list what you did wrong. You're going to put a focus on what can you improve in your trading. What did you see that day that you could be improving upon? And then finally, you're going to wrap it up with a very positive thought about something that you are grateful for that day. I think noting down the things that you are really grateful for is a very positive mindset-focused step that you can take each day.
Especially going through as well, because if you obviously do this every day, you may have by the end of it, technically you could have 200 of these in a folder or whatever. And then, you might want to do yourself a monthly review where you just read back through them and say, well, what was I grateful for? And it really does focus the mind, and you can see how you're improving.
Yeah.
So I think it will be good to be able to, there's a couple of podcasts I listen to, and obviously he talks about looking back at journals from 2005 and 2008. And I'm thinking people can save these, they can put them in folders, and you can literally look back for 6 months, 12 months, 2 years, 5 years and go, well, how have I improved? And, it's the same as like losing weight, isn't it, Roxy? You can, a lot of the time you don't see it when it's close up, but you have a look in 6 months' time and think, wow, I've been to the gym and put muscle on, or I've lost this weight, or I've improved in these trading aspects. So I think it's going to be good for people. It's also something quite nice about having something printed off.
I love it. I do everything by hand. I do very much enjoy that. And really the reason behind this that we wanted to share not only was your guys' request, but also this is representative of what I do in my journal to try to help me focus on what am I doing, what am I improving, and it is fantastic to be able to look back on. It really helps me to see and have identified the things that I struggle with and the things that I'm really doing well that I can focus on and build on. And then the next page that we have here, I'm going to let Ian take this away.
Yeah, basically, this was something that I had done for a while, just literally in a lined piece of paper. But the idea is that each trade that you take during the day has a separate page for itself, obviously with the lovely Mark Douglas quote on there. When you genuinely accept the risks, you will be at peace with any outcome. It goes back to the old process over outcome, doesn't it?
It sure does.
So you'd pop your date on there. Say this is the start of today. So I would put today's date, the 11th, the 1st. I would put trade number 1. I would put the time that I executed the trade. So say it was midday. And then how are you feeling at the time that you actually execute? So, trade was to plan, feeling confident or feeling good, or, it was to plan, I will accept whatever the outcome is. And then you can either pop a plus there or a minus. It will also make you think if you're taking something that you shouldn't take, then maybe it'll give you pause for thought either before you take it, or maybe you want to close that trade if you've taken it outside of your plan. So you might want to put a negative in there. And then the idea is, whilst you are in the trade, you can jot the time down and how you are feeling. So I tend to do it maybe every 10, 15 minutes, depending on how it is. So it may be a case of entered the trade at 12 o'clock, feeling good, trade was to plan. And then, 12:35, feeling a little bit stressed, trade is in profit, but desperate to close, desperate to take profit. And that could be a negative or a minus. It could still be a positive because you're still in the trade, despite the fact you're feeling like that. And then it could be, 12:45, traders hit 3R, closed 50% and moved stop to break even, feeling much more relaxed. Now the risk is off, plus positive. And then basically you can rate how you were feeling at the bottom, this trade's mindset rating. So how you were feeling during, on completion of the trade. So you may say, right, well, during that trade, mindset wise, I was a 2. I was feeling very stressed during it. However, I did execute my plan. Or it may be a case of, you may have been feeling stressed during it, but because you executed the plan, you give it a 4-star rating. It's really down to you how you use this. It may be a case of, as long as you followed the plan, then the mindset rating is solid. If you maybe were stressing, but you stuck to the plan, you can customize it however you want, Roxy, can't you? So it may be a case of the mindset is for positive, is for negative, but also how you felt during the trade. So it goes back to what we discussed earlier. But rather than how you felt for the whole day, this would be how you felt for that specific trade. So let's say you took a trade out of plan, you were 2 on your mindset and you felt a bit negative. But then the next 2 trades you took that day, big smiley face, 5 out of 5. And your overall for the day might have been, okay, or it might have been, look, I started off badly, but I finished the day strong. So it's really specific to the trade that you have taken. So for me, I'm aiming to take 3 trades during the day. So what I would do, I would print off 3 copies of this page, and then I would print off 1 copy of the page that Roxy showed you earlier. And that way I would complete my 3 trades, and then I would complete my mindset review for the end of the day. So that's how we see it being used.
Yeah, and that's perfect. This is a fantastic tool when you put yourself to the test. So I talk about frequently pass the test. That's something that worked really fantastically for me. I've set it to Ian as well, and he's done really well with that for building his mindset. This type of tool is fantastic for that because what you can see is the trade by trade tracking of how you did with your mindset. And you can see, hey, I did fantastic with my mindset, but I was feeling crummy about this, but I passed the test. And what you'll see over time with that 2 weeks, 1 month, whatever you choose to do for that type of pass the test, as we've talked about it, this can help you to see that over time, what you'll see is I feel better and better about the trade as I keep that mindset really strong, tipping the scale to success for yourself with this, because you can see over time, holding to having a strong mindset and just executing my trades as I'm intended to do, even when I'm not as confident in it, really does build that strong mindset.
The thing is as well, what you could do, I talked in another video about having a kind of compliance or a stacking of the habits. So stacking a good trade, followed by a good trade, followed by a good trade. What you could do here is put, even if you wanted to, right at the top of the page, a +1, and then the next day +2, and then the next day +3. And as you get 10, 20 trades in, and you can see that you are hitting good trade after good trade, day after day, or you could write it in the, put the time and just put +1, to my compliance or +1 to my habit stacking. And the idea is that you don't break the streak, you keep it going. So you could add something like that in there as well. It is really up to you how you use this, but it's giving you the option to keep track of things. And also, I think if something's written down and it's in front of you and it's to hand, you will do it. It's quite easy to just go, oh, I'll just take a quick trade here. No one's looking. No one will see. I'm not going to put it in my main journal. Whereas if you're actually thinking, well, for each trade that I take, every time I click that go button, I need to complete one of these, it will really focus the mind, that it will hopefully stop you, one, over trading, and two, taking something that you really shouldn't.
And the last page that we have here is notes. So this one's really just date, trade number of that trade. And then it's just an area for you to jot down some notes about the trade, what you were seeing for why you held the trade to where you did, whatever it may be. This is the area where you can print these out, any number that you need, again, to track any information you need. This is just kind of some extra space, basically. But guys, this is what really builds out your journal. You have 3 covers to choose from here: TTF, Color Splash, and the Electrified Brain here. And then you have your mindset review page. This is what you're going to do at the end of each day. This is going to help you to keep track of how you did overall. And then you have these pages, 1 per trade, to help you track what's going on in each trade. And then a notes section. And you build out your journal how it best fits you. But this is a fantastic way to be able to track and build out that trader's mindset.
Yeah, I started using it today. I got a ring binder, printed off a load, put it in there, and honestly, it was great. It was nice to be able to handwrite something down and be able to look back at it at the end of the day and go, God, I was stressed during that, but you know what? I stuck to the plan and +1. So yeah,
awesome. Fantastic.
It's good. And I think you guys will get benefit from it. Obviously, if there's any questions about it, let us know through the Discord, but we think it'll be really good for you. And we could do some festive covers and things around Christmas and things like that, Roxy.
Oh, that'd be fun. I like that.
Yeah. So
well, you guys let us know what you think, and let us know, again, if you have any questions.
No problem.
Thank you. We hope you enjoy.
Take care. Bye-bye.
Welcome to our new series, Mindset Shorts, with Roxy
and Ian, aka Alp27.
For those of you who don't know us, we're the TTF Mindset team. Each month, we will take a few mindset-related topics like quality trades over quantity, how to trust your analysis, revenge trading, and the benefits of mental resets, conquering FOMO, and much more.
In each video, we'll give you our thoughts on why our minds sometimes get in the way of progress, but more importantly, what we would do when this happens. We hope you enjoy this series, and more importantly, that these episodes help to strengthen your mindset and your trading.
All right, welcome everybody. My name is Artie, and this is your introduction to price action trading. In this video, we're going to introduce you to concepts of price action, its importance in the financial markets, and cover some basics and advanced principles and concepts. So let's just get right into it. Price action trading is a strategy used by traders to make trading decisions based on the price movements observed on the chart, rather than just relying on indicators or other technical analysis tools. The primary belief behind price action trading is that all relevant information about the financial instrument is reflected in the price. By studying and interpreting price charts, traders aim to identify patterns, trends, support and resistance levels, and other price-related signals to make informed trading decisions. These are the things that you're going to learn in this course: reversal patterns, bullish and bearish candlestick patterns, identifying market trends, whether it's a bull market or a bear market, as well as learning about areas of consolidation and support and resistance level. Just imagine that this course is the intermediate course on steroids. I do, however, want to stress the importance of price action trading. Every single good trader uses some form of price action to help them with their day trading. It helps you make better and more informed decisions. It helps you get the best entries possible on your trades, and it allows you to trade in any market conditions, whether it's up or down or flat. This course is also going to help teach you what type of trader you are. Whether you only want to trade trending markets, getting those higher highs and higher lows, or you feel advanced and comfortable enough trading these consolidation zones from the high to the low point. With all of the tools that you're going to learn in this course, you will be able to trade any time of day. You will be able to see every single one of these patterns and setups all day, every day. Also, this entire presentation is going to be downloadable for you, so you can use these images that I show here as reference guides. You can print them out and have them on your desk. Use these when you're first getting started until it's so ingrained in your brain that you don't need them anymore. And please feel free to watch this entire course a couple of times over, just so that you memorize everything. And for specific videos, you can save them and watch them individually. All right, that's enough for the introduction. I'll see you in the first lesson. All right, welcome back to our price action trading series. In this video, we're going to dive into the art of reading price charts. Understanding how to interpret price action movements is crucial for successful price action trading. So we got to start with the basics. Candlestick charts are widely used in price action analysis due to their ability to provide detailed information about the price movement. Each candlestick represents a specific time period, such as the 1 hour or the 1 day, or if you're like me, the 1 minute. And each candle displays the opening price, the closing price, the high price, and the low price for that period. So let's just break these down. Here you can see a green bullish candlestick, meaning it's going up, and a red bearish candlestick, meaning it's going down. Let's just say that these are 1 hour candlesticks. So it took an entire hour for this entire candlestick to form. And let's say this price opened at exactly 1 o'clock. So at 1 o'clock, the price opened right here, came all the way down to this point, and then started to shoot back up, going all the way up to the high point, which is right here. Then just before the hour was over, it came back down a little bit and closed right here. So price opened, went down, went up, came down, and closed. At 2 o'clock, the next candle prints. If it is a bearish candle like this one right here, it would open right here at the same price that the previous candle closed. Price went up a little bit, then came all the way down here to the low point, came up back a little bit, and closed right here. Every candle tells you a story. So imagine this one, if it came down, looked like it was going the opposite direction, and then skyrocketed up, lost a little bit of momentum, and closed right here. That loss of momentum caused this next candle to just shoot straight down. This big clunky part is called the body, and these top parts are called wicks or shadows. Now we're going to get into candlestick patterns and their meanings. Candlestick patterns are visual representations of price movement that provide valuable insights into market sentiment and potential reversals. So as you can see right here, these are all bullish candlestick patterns and these are all bearish candlestick patterns. So what I'm going to do is kind of show you an example right here. Imagine that price is coming down on every single one of these candlestick patterns, right? But they all stop right here. So this right here would be a level of support, meaning the floor for a price that it does not want to break through and rejects off of to continue up. Seeing any one of these candlestick patterns on a level of support is a good indication that you should enter your trade. The opposite goes for bearish candlestick patterns. This right here would be an area of resistance, and any one of these candle formations at this area would be a good indication to take a short position. As you can see, most of these trends continue pretty hard right after that candle formation, so when you enter in your trade, your stop loss is going to be above that level. Now, because you've already learned these patterns in the intermediate course, what I want to do now is show you how these look in the live markets on TradingView. All right, welcome to TradingView. Right now, we are going to get into candlestick patterns. The first one that I want to cover is the hammer candle formation, and the second one is the shooting star. Hammer is bullish, shooting star is bearish. So as you can see here, no wick on the top, small body on the top, and wick on the bottom for the hammer. No wick on the bottom, small body, long wick on the top for the shooting star. It's very easy to trade these because your stop loss and your take profit are extremely easy to set up. For a short position, you enter on close of candle, and your take profit, whatever your risk to reward ratio is, either a 1 to 1.5 or a 1 to 2. Those are the two minimums that you should be shooting for. Same goes with a buy order, stop loss below the wick, 1 to 1.5 or 1 to 2. And as you can see, just using this candle formation alone does not guarantee you a winning trade. You need to have other confluence. And if you want a little bit of extra help when finding these candle formations, what you can do is type in all candlestick patterns into TradingView, and it will give you an indicator. In the settings of all patterns, you can select which patterns you want to trade and which ones you want to see. I've selected hammer and shooting star, then just clicked OK, and as you can see, hammer and shooting star. This makes it extremely easy for you to identify candle formations. The next one we're going to focus on right here is the inverted hammer. Again, you can use the indicator to find these, and the indicator will show you if this is a bullish or bearish signal. But because you know candlestick patterns, you know that this is a bullish move. Enter your trade 1 to 1.5 and you're good to go. Again, don't use this as a standalone indication. Now, same goes for the hanging man. Enter at close of candle. Stops above the swing high, and a 1 to 1.5. Next up, we have the Dragonfly Doji and the Gravestone Doji. This right here is an example of a Gravestone Doji. Enter in on close of candle, stop loss above the wick, and target at 1 to 2, 1 to 5, whatever you want to do. Here's an example of a Dragonfly Doji. Stops below the wick, and the take profit 1 to 1.5 or 1 to 2. One thing I want to emphasize with this candle formation is that it rarely prints. This is on a 1 hour time frame, and I'm just going to scroll through, and you can see 1, 2, 3, and nothing forever. Nothing. 0. Nothing. So don't solely rely on this one for your entries because you will enter a trade once a month. Conversely, if we look at engulfing candles, we can see that they happen absolutely everywhere. But to help mitigate this and not take every single one of these, what you can do is my favorite, and that's going to be a 3-line strike, where you had 3 consecutive candles in one direction and then an engulfing candle in the opposite direction. Same goes for this entry. You are going to enter at close of candle, stop loss above, and you can go ahead and target whatever your risk to reward ratio is. Same goes for a bullish 3-line strike. You get the picture. These are much more reliable than just standard engulfing candles. But keep in mind, even right here, you had 3 lines and a strike, and you would have gotten stopped out. You need to have multiple confluences. All right, now with the morning doji star and evening doji star, these are going to be really, really rare. Right now, I've labeled doji candles, and as you can see, we had bullish move up, doji candle, and bearish move down. Close of candle, take profit, and stop loss. Again, these doji candles on levels of support and resistance are going to be much more valuable than just standalone, because you can see they happen quite often, pretty much everywhere. Next up is going to be the 3 black crows and 3 white soldiers. Right here you can see we had 1 big bearish move down, 3 bullish movements up with your 1 to 1.5. I don't like this one as much because you're waiting basically for 1 entry candle and then 2 confirmation candles to confirm the direction of the move. But it does work right here. You can see 1 bullish candle, 3 bearish candles, and you got stopped out. But again, using this strategy at key support and resistance levels, you get your bullish candle up, 3 bearish candles down, bet your short position, 1.5 or 2, whatever you want to do, and we get some nice winners. Now, let's talk about support and resistance levels because these are key elements of price action trading. These levels represent areas on the charts where buying Now, let's talk about support and resistance levels because these are key elements of price action trading. These levels represent areas on the charts where buying or selling pressure has historically been significant. So right here, a support level, also known as a floor. This is a price level where buying pressure exceeds the selling pressure, causing the price to bounce up. Resistance up here, or the ceiling on the other hand, is a price level where selling pressure exceeds the buying pressure, causing prices to reverse downwards. Being able to identify these levels helps traders make informed decisions about potential entry and exit points. Now, just to quickly explain this, if you find yourself in a consolidation area like this, imagine this is all you're seeing, just this section of the chart. What I want you to do is draw up support and resistance areas and a line right in the middle. You only want to take buys here, and you only want to take sells right here. This will keep you away from the middle section, because if you get in on the middle section, you're kind of screwed for a while, as you can see. We'll go more in depth in support and resistance when we do our breakout trading section. With support and resistance, this is just a brief rundown. We're going to go more in depth with this once we start talking about breakout trading, because breaking out of these support and resistance levels is the things that you want to focus on. But I do want to show you a quick example of how to trade these ranged markets using that halfway line that I drew up. Okay, so the next thing that I want to talk about is consolidation areas. Areas in the price where price does not move. It does not continue its uptrend and it does not reverse into a downtrend or vice versa. You can always tell when these areas start when you get the first break of structure. So you can clearly see right here, we were making higher highs and higher lows. Then when price made a lower low, it failed to make a higher high, making a lower low and failing to make a higher high. This area right here is now your area of consolidation. At this point, you do not know if the trend is going to reverse or stay in a consolidation area. After a trend stops, it's either going to consolidate or it's going to reverse. What you can do once you draw up your box with the rectangle tool is click on your box, click the settings wheel, and extend it to the right. That's going to extend your consolidation zone, and now you are looking for breakouts above or below this area. As you can see, you can get stuck in consolidation for a very long time. If, however, you do want to trade this, because it's the only thing you're stuck in and you like trading consolidation areas, which I don't suggest, what you can do, and a general rule of thumb is, if price came up into this consolidation zone, meaning it was bullish before it got here, it could potentially break out to the upside. So take your Fibonacci tool and draw it from the bottom to the top of this range. You will see here on my Fibonacci tool, I have the 1 level, the 0 level, and the 0.5, meaning this is the 50% area. You can see my settings right here for the Fibonacci tool. I have found it best now to only look at the entry, the 50 level, and then standard deviations above with Fibonacci extensions. So once price breaks out of the original zone, the extension levels are going to be 0.5, 1, 1.5, and 2. We will get into Fibonacci's a little bit later in this course. But for right now, if you are stuck in a consolidation zone and you want to trade this, only buy here and only sell here, the upper half and the lower half. The closer you can get to the bottom of the range when you're buying, it's better. The closer you can get to the top of the range when selling is better. If you enter a long position here, the most you can get is a 1-to-1 risk to reward ratio, and you could get stuck in this trade for a very, very, very long time. As you can see, price did not want to do anything in this zone. Until finally, many moons later, it broke out, but then came back in the range. This didn't even want to break and retest and reject. It broke, came back in, played around in this consolidation area again, grabbing a little bit more liquidity here, and then shooting up. I don't like trading consolidation. Wait until price definitively breaks out of this zone, retests it, and goes up. But taking this out to a higher time frame, you can clearly see the potential of breakout trades. We'll go a little bit more detail into this a little bit later in the course. All right, so now we're going to focus on trend analysis. This is a fundamental aspect of price action trading. Understanding the different types of trends and how to analyze them can really enhance your trading decisions. Trends are as they sound. They are a fundamental concept in price action trading. They represent a general direction in which prices are moving over a specific period. As you can see right here in this depiction, this is an uptrend, also known as a bull market. To identify the uptrend, we look for a series of higher highs and higher lows. HH is a higher high, HL is a higher low. This makes a staircase pattern up, higher highs and higher lows. Conversely, to identify a downtrend, we look for a series of lower highs and lower lows. Lower lows happen when this low goes lower than this. Now, price does any one of these three things. It either goes up or it goes down or it starts to consolidate. These right here are called trend lines. Trend lines always go on the bottom of price, the lower lows and the higher lows. Never draw your trend line right here. Imagine that both of these lines connect. If price is trending up, making higher highs and higher lows, all the way up here, but then when price came down, it still made a higher low, but it failed to make a higher high. Right here is your indication that market structure is most likely broken now. Once it makes a lower low, it confirms the break of market structure as well as the trend line, thus starting your new downtrend. That's one scenario. Another scenario is that price just falls into a period of consolidation and either reverses or continues. Now, let's jump into the charts and I'm going to show you how this actually looks on TradingView. What I want to do is talk about market structure, looking for bull markets and bear markets as well as these areas of consolidation. So as you know, we had a bull market coming up into this area of consolidation. What I would like for you to do in order to find bullish or bearish market structure is zoom your charts out as much as you can. I want you to not focus on the finite individual candles because those are fractals. I want you to look at the overall consensus of the market. When you look at this area right here, what is price doing? It is going up. So the trend of this area is bullish. So what price does after it stops a trend, stops being bullish, it falls into a period of consolidation. Once it breaks out of that range, it will start a new trend. And you can clearly see that the trend here was bearish, making higher highs and higher lows as we've explained in the slide you just learned. And as you can see, bearish structure making lower lows and lower highs. Now, what I would like for you to do is learn how to draw a trend line. The general rule of thumb on trend lines is you want a 45-degree angle. That is a nice, healthy trend. This is not a trend line. This is a parabolic movement in one direction. This is a trend line. You can only form a trend line when price has hit a specific area 3 or more times. So as you can see, 1, 2, 3, 4, 5. At this point right here, you could have started drawing your trend line. Then as price rejected on that and you've drawn your trend line, you can now wait for your next entry of the trend line. Rejection again, continuation up. Now, one thing I'd like to note, because in my visualization of a consolidation zone, it was perfect. There was a support level and a resistance level, and everything played perfectly in between that because it is a graphic depiction. The real life markets are not like that image. So when we fall into a period of consolidation, this is all we're seeing, right? Before the trend line breaks. Like I said before, if a trend line breaks, it's either going to reverse or fall into consolidation. What price likes to do in areas of consolidation is grab liquidity. Because this is the original area of consolidation, expect them to take out liquidity from below it as well as above it before it breaks out in one direction. This is why I don't like breakouts of consolidation zones. Then once we've broken out into the bear market, we are now looking for a new trend. If you drew your trend line here on 2 touches, this third point would invalidate it. This one would just completely not work. Same with this one, same with this one. It's not until you get another rejection where you can see price rejected, price rejected, price rejected. But by this time, the trend is already over and price decided to break it to come back up into that consolidation area. This is why a lot of people don't like trend lines, because sometimes 3 touches is all you get before the trend stops. So you miss the entire trend. And that's literally the entire market, guys. Price either consolidates, goes up, or goes down. Again, consolidation, up, consolidation, down. Up, consolidation, down. That's all the market does all the time. So instead of looking at the markets like this as zigzaggy mishmash, you can begin to start putting some structure on it by showing clear trends and clear areas of consolidation. This is your first step into the price action trading world. I really hope you guys got some value out of this. This is going to set the foundation for the rest of this course. So if you need to rewatch this, please do so. If not, we'll see you in the next video. All right, welcome back to our price action trading series. In this video, we're going to explore key price patterns that are commonly used in price action analysis / trading. These patterns can provide valuable insights into potential market reversals and continuation. So let's just dive right into it. Continuation patterns are price patterns that suggest a temporary pause in the prevailing trend before it continues. The flag pattern right here is a continuation pattern that occurs after a strong price move, in this case up, and it resembles a rectangular shape. This area right here represents a brief consolidation before the trend resumes. This flag pattern is characterized by parallel trend lines and provides an opportunity for traders to enter the market in the direction that price came into it. So these two lines are parallel. Price zigzags in between them with the potential to break out to the upside. Conversely, for a bearish flag pattern, it's the exact opposite. Price comes down, stays in this channel, which is a rectangular shape with the potential to break down to the downside. Another continuation pattern is the pennant. Same concept as the flag, except the wedge gets tighter and tighter instead of being parallel. As you heard me discuss in the intermediate course, falling wedges and rising wedges have mixed reviews. They can either be continuations or reversals. Let me show you some examples on the charts so that you can see exactly what these look like, not just images of zigzag lines. All right, welcome to TradingView, and in this section, I'm gonna show you examples on live charts, what flag patterns and pennant patterns look like. These are gonna be continuation patterns. So what you want on a flag pattern is a crazy impulse move up. I want it to be parabolic. And then once that's over, it will fall into a period of consolidation. This area is marked up with this flag pattern. These are 2 parallel lines. In order to get parallel lines, now once this starts forming, what I want you to do is draw a trend line once it starts rejecting. In order to get this to be parallel, what I want you to do is clone it so that it is the exact same angle as the other one. And as you can see, this is a perfect flag pattern, a little bit of wicking out here and there, but this is essentially what you're looking for. What I want you to do is avoid false breakouts. I do not like to trade the breakout or retest of these flag patterns. What I like to do with continuation patterns is recognize that this pattern is forming and use that information to make the most educated decision on where I want to get in. Another way of looking at these continuation patterns is an impulse move up and a retracement. What other tool do we use for retracements? That's correct, a Fibonacci tool. So you find the move that was the impulse up, the beginning of the impulse. You can either do it here from the bottom. Everybody's Fibonacci retracement tools and locations of start to finish are subjective, but I like to go from the bodies to the bodies. And as you can see right here, this was a 50 level retracement on the Fibonacci and it just shot straight up. So instead of taking a long position on the breakout and having a huge stop loss with a 1 to 1.5, you can look for Fibonacci levels and get a higher risk to reward, targeting a same top or a Fibonacci extension level. The same goes for short positions. You want the impulse move down, flag pattern to be formed, expecting a breakout to the downside. Now this is current price action with the live price right here. As you can see, There are multiple pennants being formed here. I like pennants better because you can see the buying pressure. The move had an impulse up, and then as price came down and started to consolidate, it did not break the market structure, still making higher lows. These types of chart patterns show the health of the bullish movement. So even though it's consolidating in this range, the buying pressure of the impulse move is still there. Then when it breaks out, comes back into another pennant formation, you can still clearly see the buying pressure happened right here. It happened again right here and broke out to the upside. So just like with the flag pattern, you want the impulse up, pennant shape, continuation. Break out, impulse up, pennant shape, continuation. Pennants, in my opinion, are way better.